Well, I mean, if we do get that cooler CPI number, the market will almost certainly bounce a little bit further, but I just don't know how much longer it can. And the biggest thing is because of valuations. It's not just price earnings ratios, which can be, people can play with the earnings, but they can't play with their sales. You look at price sales ratio, 2.3. I mean, that was what we saw at the top of 2000, and much higher than what we saw at the top of 2007. Forget about what we see at bottoms. And so, the thing is that every single bear market since World War II has seen a PE ratio fall to at least 15 times earnings. And so I think that the markets just can't stay at this kind of level for an extended period of time without QE, without sort of massive levels of liquidity injections, which we're not going to get. I mean, I guess my point is that the big thing when it comes down to the economy, even if we don't fall into a recession, when you got a market that's trading at 19 times earnings, it has to come back down to fairly valued. Remember what happened in 2000 to 2003? We had one of the mildest recessions in history. And yet the stock market still got clobbered. Why? Because it started at an incredibly high valuation level, extremely high valuation, and it just takes much longer for it to get back down to fairly valued. We weren't as highly valued or as extremely overvalued this time, but I still think it has further to go.
Mike Santoli, I hope that period is indicative because, and some have said the reason why, 07 was so much worse is because of leverage, because it went straight through the banking system. And maybe we can come out with something like the dot-com example where we lose $12 trillion of wealth and the economy barely makes a ripple because of it.
Right. That absolutely would be a relatively constructive outcome, or one that you might hope for if, in fact, you think we need to have some kind of downturn. I do go back to maybe relying on the idea of this is a relatively singular economic cycle. I'm not saying the rules don't apply. I'm just saying the sequencing seems to be off somehow, right? So everyone says the market's never bottomed before you got into a recession. That's true, but this market was down 25% when earnings were at their peak, and the yield curve hadn't yet inverted, right? So you had some kind of leads and lags that are very hard to decipher. And I do agree, if you have a dismantling of the high-value NASDAQ stocks and $1 trillion goes out of crypto and all these other things happen off to the side and it doesn't really impact the real economy because it was supported by pretty decent consumer balance sheets and all the rest of it, that's great. Maybe that's our way out. The other piece about valuations is that it continues to be skewed by the very largest companies. The equal-weighted S&P 500 got down to about 13 times earnings, so 13, 14 late last year. The mid-caps are still basically there. So my point is, I'm not trying to make excuses for it, but you could have two ways out. Either the average stock does better than the index, or forward returns are just not that good. If October was the bottom, it just means you didn't flush it out very much.
And Matt, that's what's fascinating. I don't think Mike or I want to be the people who get up here and say this time's different, but it's like it is in some ways. In many obvious ways it is. So could any of these persuade you to feel less bearish if this one is just going to be a little bit different than your typical game book?
Well, it's still, as you say, it's never different this time. But there's always a little different this time, of course. But I think the best, again, it goes back to what happened in the late 1990s. We had this huge influx of liquidity back then, as I've said for many, many years. I know Art Cashin has talked about this. Back then, that was kind of more behind the scenes to solve the problem with Y2K. Then when Y2K was solved, they solved it well in the year 2000. The liquidity disappeared and the market went down. This time, it was a massive liquidity to save us from the pandemic, which basically shut down the global economy. Now that that's being pulled away, it's going to take longer for it to unwind, and it's just like it did back then. Again, I'm not calling for the same kind of 50% decline in the S&P and 80% decline in the NASDAQ because it wasn't as overvalued. But I just think that when we compare apples to apples, the liquidity situation is such that the only way we could stay at 19 times earnings if we have more, a new QE program, more liquidity.
Sure.
I just don't see that in the offing, even if the Fed pauses at some point.
It might.
Quite soon.
Right.